A very good morning, students. Our session of Financial Management 1. As far as our previous session was concerned, in the last session we have seen about the introduction of venture capital, and along with the introduction we have seen the different institutions who provide the direct capital, and that is the venture capital to those industries who come up with the new idea, new innovative products, and the nature of business is totally risky. So when the nature is associated with the risk, so it is very difficult to get the finance, the direct finance in the market. So there are few institutions which provide the direct finance to these industries. Now today we are going to discuss about the stages or the steps in venture capital finance. Normally, there are two stages in venture capital. The first one is early stage, and the second one is later stage. Now, as far as the early stage is concerned, it is divided into three parts. The first one is pre-startup, then after startup, and the last one is about second round financing. So now let's start with the first stage, that is early stage. Now early stage, the name itself suggests when the organization is there in their early stage or in the initial stage of the startup of their venture. So that time period is known as early stage. Now the early stage is divided into three main parts. The first one, that is pre-startup. The name itself suggests pre-startup means when the organization is going to start their business, but there are few expenses, there are few requirements which is to be fulfilled before the startup of that particular unit. And when the venture capitalist provide a finance for that early expenses, for their early requirement of the finance, so that is there in the startup, and that finance is known as pre-startup finance. Now generally it is totally depends, or it is totally concerned with the research part. Now before, when you are going to start any business, first and foremostly you need to give a proper time in the research and development area. Development will be there, but it is there in the next stage. But first and foremostly, we are going to give our 100% in the research area, because if the research is sound, if the research is pronounced, and if the research is there with the perfection and with the nitty-gritty analysis of the market and the analysis of the particular product which you are going to introduce in the market for the first time, so a maximum finance is requirement, because in a research some experiment will be there, and which is going to be performed by the person who is going to start this particular business. So, organization requires maximum finance for the research purpose. No one is going to introduce their project without taking or without having a proper research of that objective or proper research of their project. So, the pre-commercialization research project normally accepted to end in a prototype which may or may not tends to launching a business. Here, business person is preparing one blueprint of his idea of his project. When if the project is feasible, then directly they are going to start the business, or venture capitalists provide funds to them. But make my words, if they fails in the blueprint, when it clearly shows that this project is not able to earn more because it is not feasible when the practical application of the project is concerned. So, in the pre-startup stage, the company and venture capitalist comes to know that how the project is going to be accepted in the market. So, market analysis is also required in the pre-startup stage. Then after the next stage, that is startup. When pre-startup stage is completed and if the organization gets the positive result in the blueprint side and in the market side, then definitely they move forward and they are going to move forward in the startup stage. Now, startup is a stage when the actual, or we can say that when the commercialization of the project is there in the real manner. When actually you are going to start your business, when actually product is there under the production process, when actually the product or the new services is offered to the market, and when slowly and gradually market is going to accept the project, accept the product, and they are going to tend the services. So, startup is a stage when the actualization or commercialization of the project is there. Now, at this stage, venture capital financing organization provides the finance, the primary finance for the product development and for the marketing purpose. This is really very important stage because here the commercialization of the product is there. When the actually production process is going to be started and product is going to introduce in this stage. So this stage is really very important stage, and the success or failure of the venture capital is totally depends upon this startup stage. Then after third one, that is second round financing. Now this is the stage when venture capital firm provides additional finance to those industries which product has already been launched in the market. When the product is already there in the market, but again they required a more finance for the production purpose or either for the marketing purpose. So this is the stage when the product is already there in the market, but they required the finance for the production purpose and for the marketing purpose. So this is the explanation of our first stage, that is early stage. In that we have seen three different types. The first one, that is pre-startup, the second one is startup, and the last one is second round financing. Now the next main stage, that is later stage. Later stage, it is a stage when the product is already there in the market. The product is already developed in the market, but for the modernization purpose, for the growth purpose, or for the development purpose, when the firm required maximum finance, the maximum capital for the financial companies. So that stage will be known as later stage. This stage involves established business which demand extra financial assistance for their growth and development purpose. Now this later stage has a time frame of 1 to 3 years and falls under the medium risk category. The risk perception is very moderate in this later stage, but the risk is very high in the early stage. The time period of the financial assistance is of 1 to 3 years. So this is the stage in which the product is already known to the market. The customers are the regular customer. Now organization is not there in the search of their potential customers, because the product is already launched, it is highly appreciated in the market, they have the regular customer, but now the financial assistance is required for the expansion of the current business unit. The financial requirement is for the modernization purpose. So again, this is one of the main stage of venture capital financing. Then after, the next point is methods of venture capital financing. There are different methods of the venture capital financing, and through this method the venture capitalist is going to analyze the risk perception which is involved in this particular business concern. This point is not important as far as your exams are concerned. It is only the basic understanding. So, if you have a book, then just read out these three methods, that is conventional method, the first Chicago method, and revenue multiplier method. And those students who do not have books, they are going to read whenever they get their books. So that's about the methods of venture capital financing. Now the next point, that is the types of disinvestment mechanism, that is the exit strategies for venture capital fund. Now disinvestment is a point where organization is going to allow the general public for their investment purpose. Now the venture capital, the firm has a proper finance with them. Now it is a time that they are going to start about the exit strategy, means how they are going to invite the general public, the market, for their investment purpose. સિમ્પલ લેંગ્વેજમાં એક્સપ્લેન કરીએ તો ડિસઇન્વેસ્ટમેન્ટ એક એવું સ્ટેજ છે કે જેમાં કોઈ પણ ઓર્ગેનાઇઝેશન, કોઈ પણ બિઝનેસ યુનિટ એ પોતાના ઇન્વેસ્ટમેન્ટને ડિફરન્ટ એવેન્યુઝમાં ડિવાઈડ કરે છે. નાઉ that particular business unit is not depends upon the single financial institute itself. કોઈ પણ ઓર્ગેનાઇઝેશન હશે એ ઇનિશિયલ સ્ટેજમાં જનરલ પબ્લિક પાસેથી ફંડ કલેક્ટ કરી શકશે નહીં, અથવા માર્કેટમાંથી ડિરેક્ટલી ફંડને રેઝ કરી શકશે નહીં. બિકોઝ ઇનિશિયલ સ્ટેજમાં ઓર્ગેનાઇઝેશનનું રિસ્ક મેક્સિમમ ટુ મેક્સિમમ હશે. પ્રોડક્ટ માર્કેટમાં સક્સેસ થાય છે કે નથી થતી એનું નોલેજ નહીં હોય. એન્ડ the credit worthiness is not there in the market. ક્રેડિટ વર્ધીનેસ પણ માર્કેટમાં એટલી બધી સાઉન્ડ હશે નહીં. તો હવે આ સિચ્યુએશનમાં ઓર્ગેનાઇઝેશન સિલેક્ટ કરે છે ડિસઇન્વેસ્ટમેન્ટ, ફર્સ્ટ એન્ડ ફોરમોસ્ટલી ઇન્વેસ્ટમેન્ટનું ઓપ્શન, કે જ્યાંથી એમને ડિરેક્ટ ફિનાન્સ પ્રોવાઈડ થાય. હવે એક વખત જ્યારે પ્રોપર મેનરમાં ફિનાન્સ ઓર્ગેનાઇઝેશનને મળી જાય છે, ઓર્ગેનાઇઝેશન પોતાના બિઝનેસને સ્ટાર્ટ કરે છે, સ્લોલી અને ગ્રેજ્યુઅલી they are making maximum to maximum profits. Then after, now they required again maximum finance for the development purpose and for the growth purpose. So they are taking the decision of disinvestment. There are basically 5 mechanism through which the company is going to disinvest their financial assistance. Under that, the first one is IPO. IPO stands for Initial Public Offering. When the organization issues shares and when they are going to offer to the general public in the open market, so that will be known as IPO. Now the venture capital investors and other private investors will get their proportionate shares, who can put them in the open market for trading only after an initial lock-in period is over. કંપની જ્યારે આઈપીઓ જનરલ પબ્લિકને ઓફર કરે છે, એ ટાઈમમાં જે ઇન્સ્ટિટ્યૂટ કે જે પ્રાઇવેટ ઇન્વેસ્ટર્સે ઓર્ગેનાઇઝેશનને ફંડ પ્રોવાઈડ કરેલું હશે, સો એ ઇન્ડસ્ટ્રીઝને, એ ઇન્વેસ્ટર્સને આઈપીઓના બેઝિસ ઉપરથી દે આર ગેટિંગ a numbers of shares worth of their investment. એટલે સપોઝ કોઈ પણ એક ઇન્વેસ્ટરે તમારી કંપનીમાં 6 લાખનું ઇન્વેસ્ટમેન્ટ કરેલું છે, હવે કંપની જ્યારે આઈપીઓ પબ્લિશ કરશે તો એ પર્ટિક્યુલર ઇન્વેસ્ટર્સને 6 લાખ રૂપીઝના શેર્સ કંપનીએ અલોકેટ કરવા પડશે. The next one is trade sales. Now in this option, the company is going to merge with the another company, or they are going to sell themselves in the market, and the main purpose behind the sale is the acquisition for cash and stocks. So when the venture capital firm is going to sell themselves in the market, so that will be known as trade sales. Then after, bankruptcy. When the organization is not able to fulfill their obligations within a particular time period, they are not able to write off their liabilities, So at that time the company may just go the bankruptcy, and now bank is going to take over each and every assets of the business unit, and the bank is now going to sell the assets of that business in the open market, and whatever money the bank is generated after selling the assets of that business, they are going to pay the obligations of the liabilities of that particular business units. The next one is buyback. Buyback of the shares. When the company itself purchased its issued shares in the market, so that process is known as buyback of shares. When the company purchases their own shares, that will be known as buyback. And the last one is write-off. When the company voluntarily declare themselves, or they voluntarily liquidate their business unit, that will be known as write-off. Due to some financial crisis, the company is not able to pay their liquidate, or they are not able to pay their liabilities. So in this worst situation, the company themselves sell the whole business in the market, and that will be known as write-offs. So this is all about the disinvestment mechanism. So today we are going to end our first chapter of second unit. Hope you all are clear about this chapter, that is sources of finance. Now in this particular chapter we have seen the different points, and that is the introduction of sources of finance is there. Then after, the types of sources of finance, that is divided into two parts, the internal part and the external part. The external part includes equity shares, debentures and preference shares. The internal part includes retained earning and bridge finance. And again, term loan will be there in the external sources of finance. Then after, we have seen the concept of bridge finance, and the last point was venture capital finance. So here I am ending your chapter number 1 of unit number 2. In the next session we are going to start chapter number 2 of unit number 2. Till now, goodbye, and hope you are clear about it. So thank you girls, thank you so much.